deals coming in at 2,138. So we're still focusing on activities in the markets now. As I said, we'll be talking about multinationals listed on the Nigerian Stock Exchange, focusing on some of them, including Nestle, PZ Cussons, Cadbury, Julius Berger, John Holt, Lafarge, with Usman Olubajo, who is an investment research analyst with ARM Securities. Usman, good morning to you. Thank you so much for joining me on the program.
Good morning, Alex.
So, taking a look at those numbers, and from yesterday's trade, where we see that the market continues to bleed investors, booking profit off most of the bellwethers, including some of these multinationals. Talk to us, what has happened to these multinationals, let's say, in the last 2 years? Has it been really good for them?
No, it hasn't been really good. Typically, multinationals are companies which list in different countries and they operate in different countries. And typically, they are bigger and they are usually more efficient. However, and ordinarily, because of their improved efficiency, they are expected to be able to weather the storm in difficult times. But the macroeconomic challenges has significantly impacted their operations, very similar to what has happened to local companies. And what you've seen, it now depends on where these multinationals play. For those who have played within the largely non-discretionary sectors, what has happened is combination of FX losses, negative real wage growth of consumers, naira weakness, as well as elevated interest rate environment has combined to impact their operations. So a number of them have tried to cut their operations, in terms of operating costs. They've also tried to raise prices in terms of their products, but in as much as consumers' income can't purchase as much as they could probably 2 years ago, and even last year, they are not able to pass through most of those input costs to consumers. Then another key pressure point for them is they've been able, because of the high interest rate environment in the country, they've been able, a number of them, raise foreign debts, and probably they had 100 million naira in terms of borrowings before. 3% depreciation of that, of the naira, implied that on their books alone, they'll be suffering additional 43 million naira in terms of FX losses. So the combination of all these has more than offset any cut in operating costs, and that significantly impacted their earnings. And of course, in line with the decline or the drop in earnings, the share prices of these stocks has actually dipped. A number of them has lost even as much as close to 60%. But if you look at it on a sector by sector basis, some of those who operate within the oil and gas sector, for example, have done really well. The likes of Total and Mobil, and of course, it's the downstream business that is listed. And what you've seen is also their improved performance has largely been dependent on systematic changes. So the partial deregulation of the downstream sector has enabled these companies to get, improved margin. The elevated finance costs, because they have to wait for government to pay them subsidy, which automatically filters through into their finance costs. All those has been removed, and their operating performance has improved. On average, between these two companies, they've been able to report over 2016, their share price was on average higher, about over 80%. Although Total's one was, of course, over 100%, but that of Mobil, apart from the improved operating performance, was also linked to the disposal of Mobil Downstream, 60% stake in Mobil Downstream to NIPCO at a premium price, which boosted investor sentiment.
But this also means that investors are beginning to shift their attention away, not too much away from the multinationals, but now on most of the domestic retail companies listed in the Nigerian Stock Exchange.
I think investors are shifting their attention away from the equities market in general, because fixed income instruments is more, as in your capital and your interest is guaranteed, and because interest rates are looking so attractive, a number of them are concentrating towards that, towards that sector, as in investing into fixed income securities. But yes, there are some who are still interested because of their risk appetite, still interested in in the equities market. But their focus has been more of which companies play within the non-discretionary sector, in which they can be able to better pass through most of these input cost pressures to consumers.
So for you, as we count down, because of course February is when most of these companies will be turning in their corporate earnings for 2016 full year, for some of them anyways, what are you expecting? What would surprise you coming in from these multinationals, bearing in mind that they've had to operate in very tight circumstances in 2016?
In terms of their earnings expectation, I don't think, for most of them, those who have sizable FX exposure, that is in terms of debt or in terms of trade payables, the lower than expected, the weaker depreciation of the naira over this quarter is expected to boost their operating performance. Then a number of them has also raised prices. So it's also, what would surprise me is if typically because of the weak consumer discretionary power, typically what you expect is for volume to contract over the period. But if volume remain resilient and they've been able to raise prices, then what could mean is that the earnings could actually come in better than expected. Or for some, because of the accumulated weak earnings performance over the 9 months 16, the expectation is for dividends to actually at best be in par with 2015. But most analysts expect weaker dividend payments. So should they decide to just maintain status quo in terms of their dividend payout ratio or their dividend per share, then also that could actually boost investor sentiment towards any of these stocks.
But then, Usman, it could be that most of these companies would, bearing in mind that your top line and bottom line isn't looking so good, maybe there won't be any dividend payouts at all for most of them. For most of them,
it's possible. It's possible. But in terms of our preference, we still prefer the downstream oil and gas. Their margins look impressive, although we started to see decline in terms of their margins from Q3. But relative to 2015, their earnings should still remain impressive. For those within the food, beverage, and tobacco space, earnings expectation is still weak.
All right. Usman, thank you so much for joining me on the program this morning. Of course, shedding more light on some of these multinationals. Well, Business Morning continues after now. Stay with us.